Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets. Hi everybody, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. In this week's episode, we're going to discuss the recent testimony of the interim Parliamentary budget officer and the worsening fiscal outlook for Canada and what it means for you as a Canadian taxpayer and the risk it poses for investors. For those of you who may not be familiar, the Parliamentary Budget Office, or PBO, is Canada's independent financial watchdog. Established in 2006, the PBO's role is to enhance transparency and accountability by offering non-partisan cost estimates, fiscal projections, and reporting on budgetary matters. The PBO plays a crucial role in Canada's democracy by providing independent, non-partisan analysis of government finances, which empowers parliamentarians and you, the public, to make more informed decisions, holding the government accountable for its fiscal policies. So why does the testimony of a lifelong bureaucrat deserve so much extra scrutiny? Well, if you haven't realized yet or are simply new to the channel, Canada is at a crossroads. Canada has been in a per capita recession for 3 years. It is mired in a productivity emergency, unemployment is rising, and capex in the private sector is anemic. And this was before the trade war kicked off in the spring. It is in this context we received the PBO's testimony. What caught us off guard was not only what he said, but the tone and the language that was used. Last week, Mr. Jacques warned that Canada's fiscal path is unsustainable and went on to use words like stupefying and shocking to underscore the alarming deterioration of Canada's federal financing. This strong language in describing serious concerns about government spending is a rare departure from the usually measured tone of what is typically a reserved parliamentary budget officer, and suggests the growing risk to economic stability and urging policymakers and the public to take notice and act. So what were the projections, and were they really that bad? Well, I think we should heed the PBO's warning when he says that the budget deficits are unsustainable. But the numbers are jarring, and the deficits are expected to grow to $69 billion, or nearly a third higher than in 2024. Crucially, their projections also have the debt to GDP ratios climbing from roughly 42% to 43%. And with an uncharacteristically blunt language, the PBO also highlighted surging debt interest costs, rising to 13.7 cents per tax dollar by 2030, up from 7 cents pre-pandemic. And finally, he pointed out the government's failure to adhere to any fiscal anchors whatever. As an aside, much of this jump in spending is driven by the considerable decline in federal tax revenues from personal income tax cuts and other measures, as well as even larger increases in federal program spending. Total operational spending alone is also projected to be more than $10 billion higher than previously anticipated. What's also critical for people to understand is that the projections on expenses and revenues and subsequent deficit are based on the following economic forecasts of growth, unemployment, oil prices, and inflation. If you pause the video and look carefully, you will note that these projections for growth and unemployment are relatively benign. That's because the PBO does not forecast recessions, nor should they, because that would open up a whole other set of issues. But it doesn't mean we can't consider the effects on the fiscal outlook if we do, in fact, go into what would be called a technical recession, or growth continues to deteriorate, or unemployment should rise much higher than what they have forecast. And that's what I've done for you here. Now, to be clear, I've taken some liberties with my own forecast. In truth, it's more of a guess, but the point is to draw attention to the fact that the PBO was shocked that the debt to GDP would rise in an economic scenario that was benign. Well, what if the economy continues to contract, as I expect it will, and that tax revenues fall even further? That means the deficit would be even larger than expected, and as I've shown, debt to GDP would rise. Not good. And it gets even worse. The PBO forecast is actually kind of conservative. This chart is from Trevor Tome, a professor of economics at the University of Calgary and contributor to The Hub, a website that I suggest you check out. And I'll quote him here. These projections don't count many of the government's own campaign platform commitments, including increases in military spending. Adding unannounced measures back into the PBO estimates, I find cumulative deficits over the next 4 years exceed $360 billion, almost triple what last year's budget anticipated. He goes on to say that larger deficits mean increased borrowing and rising interest costs. The PBO projections indicate that interest costs alone might consume 14 cents of every dollar, as I mentioned before, in government revenue until 2030. And keep in mind that the federal interest payments are already roughly equal to the healthcare transfers we have. Another thing that's important to note is those rising interest costs will have knock-on effects, because as interest rates generally go higher, other borrowers like the provinces will also have to deal with higher interest costs. And as you can see, they've also increased significantly. What's important to understand is that this unsustainable federal debt trajectory is also not new. Many people, like Professor Tom, have warned about the Liberal platform representing a sharp departure from even the already weak fiscal rules of recent years. What's also crazy is the federal tax take is already at a nearly 25-year high. Canada does not have a revenue problem. Canada has a spending problem. One way to demonstrate this is to look at the public sector employment, which sits at a 30-year high as public sector productivity languishes. Too much of government tax revenue is wasted on consumption rather than investment. And although there have been plenty of campaign promises to rectify this, we still haven't seen a budget. And so I'm not holding my breath. One counter-argument that I often hear, and you will surely encounter it as well, is at the federal level, Canada is actually well ahead of its peers. Debt to GDP is around 42%. And this is relatively low, I'll admit. But it's also a red herring. It's a distraction. At the end of the day, the federal government, whether they admit it or not, is on the hook for the provinces, whose deficit picture is not looking much better, by the way. In a crisis, the Bank of Canada will step in and provide the liquidity the provinces need, like they did with Newfoundland during COVID. And ultimately, that means the federal government, like it or not, owns that debt. Furthermore, hiding behind widespread global indebtedness is also bunk, because it means the risks we face are actually larger. A sovereign debt crisis or financial disruption abroad could quickly spill across borders, making growth here in Canada more volatile and dry up appetite for Canadian bonds. This is a theme that is a major focus of our asset allocation strategy here at IceCap Asset Management. One more wrinkle that further exposes the problem with Canada's unsustainable fiscal path is that Canada's bond market exposure to foreign investors is extremely high. That is to say that the share of ownership of outstanding bonds is at a record level. This means that if there were a crisis at home or abroad, our bond market is highly susceptible to the change in investor sentiment, which is all the more reason that Canada should ensure its own fiscal house is in order so that we're resilient and prepared for the shocks that may come. All right, that's a wrap on this week's episode. Please like, subscribe, and follow for more. Do share with your friends. I've gotten some really great feedback over the last couple of weeks, so I just want to thank you again. And as always, as a reminder, we manage money for families all across Canada and the world, so please feel free to get in touch.